I want to start with something that is going to sound almost impossible, and yet it is simply, provably true. The single most famous price silver ever printed, the number that lives in every old-timer's memory, the peak that people still talk about at coin shows decades later, has never actually been reached again. Not once. Not even close. And most people watching this have no idea, because the folks who move this market, the big trading desks, and the financial channels that run on their advertising, have a very good reason to keep you looking at the wrong number. If you own silver right now, or if you have been thinking about it, or if you are sitting on a retirement account and wondering whether the metal in the title of this video is finally waking up, then this is the story that matters more than any headline that ran this week. I am not going to hand you a prediction. I am going to walk you through a piece of history that the mainstream conveniently rounds off, because once you see it, you cannot unsee it, and it changes how you read every rally and every scary pullback from here on out. Here is the down payment, the one fact I want you to chew on before we go a step further. When silver made its legendary run at the start of the 1980s and touched roughly $50, that was the nominal price, the number on the ticker. But a dollar back then bought far more than a dollar buys today. If you take that old peak and adjust it for everything the dollar has lost since, silver's real, inflation-adjusted high sits far, far above $50. Which means that even in the moments when silver has clawed back to its old nominal ceiling, in real purchasing power terms, it never reclaimed its actual top. The mountain everyone thinks silver climbed twice is a foothill compared to the real summit it hit only once. Let me say that again slowly, because it is the spine of this entire video. Silver has bumped its head on roughly the $50 level twice in modern history, once at the start of the 80s and again about 3 decades later. Two attempts, about 31 years apart, at what looks like the same ceiling. And beneath those two peaks sits a base that stretches back something like 45 years. But that $50 ceiling is a mirage created by the dollar itself shrinking underneath it. Measured in real money, in what silver could actually buy, that first peak was in another league entirely, and it has stood, untouched, unbeaten, for the better part of half a century. Now think about what the title of this video is really pointing at. When people say silver is setting up a repeat of that old peak, the lazy version of that story is just, oh, it might go back to 50. But that misses the whole point. The setup that produced that first explosion was not really about a price. It was about a specific alignment of conditions, and a lot of those conditions are quietly clicking back into place today. The price is downstream. The setup is upstream. And the setup is what I want you to understand, because that is the part nobody on the financial channels will slow down and explain to you. So let me put a face on it, because a number on a chart does not keep you up at night, but a person does. Picture an ordinary machinist back then, a man who had watched inflation eat his paycheck for years, who did everything the responsible way, saved a little every month, and still felt like he was falling behind no matter how hard he worked. He hears silver is running. He drives down to the local coin shop, and the line is out the door and around the block. Neighbors, dentists, retirees, ordinary people, all clutching whatever they had, all trying to get their hands on real metal at the same moment. That is what the top of a mania looks like. Everyone suddenly an expert. The whole country crowding through the same narrow door at once. I want you to hold that image, because it tells you two things. First, that when the fear of losing your savings to a shrinking dollar finally goes mainstream, the move in silver is not gentle, it is violent, and it is fast. And second, and this is the part that should sit with you, we are absolutely nowhere near that scene today. There is no line around the block. Your neighbors are not talking about silver at the barbecue. The taxi driver is not giving you tips. Which tells any honest student of history that if this is a repeat of that setup, we are somewhere near the beginning of it, not the end. Now here is where the enemy comes in, and I want to be very direct with you about who benefits from your confusion. The big banks and the trading desks that dominate this market do not make their money by helping you understand history. They make it on your churn, on your panic, on you buying high in excitement and selling low in fear. And nothing feeds that machine better than keeping you fixated on the nominal number, the $50 sticker, so that every time silver approaches it, you think, well, it has failed here twice before. Maybe this is as good as it gets. They want you anchored to the mirage, because the mirage makes you a nervous, easily shaken holder, and a nervous holder is their favorite customer. Let me show you exactly how they shake you, because this is a mechanism, not a conspiracy theory, and once you understand it, you stop falling for it. Back in the last big silver run of the previous decade, when silver charged toward that same old ceiling again, the price fell by roughly 30% in a matter of days. Now, here's the thing that should make you angry. Nothing about silver itself changed in those days. There was no new mine, no collapse in demand, no sudden flood of metal. What changed was that the exchange raised the cost of holding a position, the margin requirement, over and over in quick succession. They did not change the metal, they changed the price of standing your ground. And leveraged traders who could not meet the new terms were forced to sell, all at once, into each other, and the price cratered. The exchange moved the cost of holding, not the value of the thing being held. Remember that distinction. It is the single most important thing to understand about why silver is so violent and so frequently misunderstood. And this is exactly the moment I need to stop and talk to you directly, because right here is where a lot of good people make the mistake that costs them the most. When you see a drop like that, engineered by the cost of holding rather than any change in the metal, your gut screams at you to get out. That is the trap. So before we go deeper, let me tell you why the smartest, quietest, most powerful buyers on the planet are doing the exact opposite of panicking. The central banks, the national treasuries, the institutions that actually move nations have been buying physical gold at a record pace, more than 1,000 tons a year for 3 straight years, roughly double what they averaged the decade before. They are not day trading. They are quietly moving real money into real metal because they understand what a shrinking dollar does over time. And they understand that metal held in your own vault cannot be frozen or printed away by anyone else. And here is the part they would rather you never found out. There is a perfectly legal, completely ordinary way for you to do the very same thing inside the retirement account you already have. Most people believe their 401k or their IRA can only hold the usual paper, the funds, the stocks, the promises. That is not true. Through what is called a self-directed precious metals IRA, you can move a portion of your retirement savings into real physical gold and silver, held in your name, without triggering taxes and without triggering penalties, because it is a transfer, not a withdrawal. This is not some exotic loophole for insiders and the ultra-wealthy. If you have $100,000 or more in any retirement account, this is squarely for you. We've put together a free retirement protection guide that walks through exactly how it works, step by step in plain English. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take a look, and then come right back here, because the next part is where this whole story comes together. Now, let me widen the lens, because the $50 peak did not happen in a vacuum. Go back and look at what gold, silver's older sibling, did in that same era. Gold started the 1970s pinned near $35, back when the dollar was still tied to it, and by the end of that decade, it had run to over $800. But here is the detail the highlight reels leave out. Right in the middle of that historic bull market, gold did not go straight up. It fell from around $200 down to roughly $100, nearly cut in half, and a whole generation of investors decided the party was over and walked away in disgust. And then, from that despair, it multiplied about 8 times into its final peak. The people who sold at the halfway point, convinced the run was finished, missed the entire second act. Do you see why that matters for you today? The scariest, most convincing drops in a bull market often happen in the middle, not at the end. They are designed by their very nature to shake out everyone who is not paying attention to the deeper story. The machinist who held through the fear got the parabola. The neighbor who panicked at the halfway mark got the regret. And the difference between them was not luck. It was understanding the setup instead of reacting to the price. So, what is the setup, really? Strip away the noise, and it comes down to this. Silver runs when confidence in paper money erodes, and when the metal is genuinely scarce relative to the demand for it. And on the scarcity side, something structural has been building that is very different from a simple speculative frenzy. The world has run a supply deficit in silver for several years in a row now, meaning we are using more of it than we are pulling out of the ground and recycling, year after year, drawing down the above-ground stockpiles that took decades to accumulate. And silver has a cruel quirk that gold does not. Gold is hoarded. Almost every ounce ever mined still exists, sitting in a vault or around someone's neck. But silver is burned. It goes into solar panels, into electronics, into 1,000 industrial uses, spread out in tiny amounts, most of it too dispersed and too cheap to bother recycling. It is consumed and gone. Gold is saved. Silver is spent. That is the difference between the old mania and what is quietly happening now. The first run at 50 was driven largely by a speculative corner, by leverage, by a frenzy that burned itself out and left a scar. What is building underneath silver today has a real, physical, structural floor to it, a genuine shortage that does not care what the screen printed this morning. And when you combine a real shortage with the return of the same monetary fears that drove that first great run, you get the ingredients for the setup the title is talking about. Not a promise, a setup. Now, let me be honest with you about the near term, because I am not here to blow smoke, and honesty is the only thing that separates me from the hype machine you are trying to escape. Silver has recently lagged gold. In this stretch, gold has held up and even pushed to new territory, while silver has pulled back harder, and the ratio between the two has widened out toward the upper end of its long historical range. And I know how that feels if you own silver. It feels like the weak sibling, the disappointment, the one that never quite delivers. But flip it around. A wide gold to silver ratio is not a verdict that silver is broken. Historically, it has been one of the loudest signals that silver is cheap relative to gold, coiled and overdue to play catch up. The bigger the gap gets, the more room there is for silver to close it. What looks like weakness is very often just a discount that has not been claimed yet. There is also a real headwind I will not hide from you, and it comes from the enemy's headquarters, the Fed. In its latest decision, a divided Fed chose to hold steady, with policymakers openly split, and the current chair, Kevin Warsh, has made it clear he intends to keep pressure on inflation and to give the markets less handholding, less forward guidance than they are used to. And higher for longer real interest rates are, historically, the one genuine enemy of precious metals. When you can earn a solid, safe, real return just holding a government bond, the metal that pays you nothing has to fight for attention. A bond that actually pays a real return is silver's only true rival. So yes, in the near term, that is a real weight, and anyone who tells you otherwise is selling you something. But here is the crack in that story, the part that should make you lean in. For decades, there was an iron rule in markets that when real yields rose, gold fell, and silver with it. Lately, that rule has broken. Metal has climbed even as real yields have stayed stubbornly high, doing something the textbooks say it should not. And when an old, reliable correlation quietly stops working, it is usually because something deeper has shifted underneath the surface, something the models have not caught up to yet. The people who wrote those textbooks are staring at a chart that no longer obeys them, and they do not want to admit it, because admitting it means admitting they do not fully understand what is driving the biggest, quietest reallocation of reserves in a generation. And that brings me to the thing I most want you to take from all of this, the recognition moment, because it is the whole reason timing matters. The smart money already sees this. The central banks are already buying. The structural deficit is already years deep. The old correlations are already breaking. All of it is already in motion, right now, while the mainstream is still fixated on the nominal $50 ceiling and calling silver a disappointment. The pension funds have not moved. The financial media is not leading with it. Your neighbor is not in line at the coin shop. And that gap between what the insiders are quietly doing and what the crowd has not yet noticed is the single most valuable thing you can understand as an investor. Because by the time it is obvious, by the time silver reclaiming its old peak leads every news segment and every advisor suddenly recommends it, the easy part will already be behind us. Nobody is going to call you and tell you the moment has arrived. Nobody sends you an invitation to be early. Being early is something you choose, quietly, before the crowd shows up. So let me be clear and careful about what this is and what it is not, because you deserve straight talk. I am not promising you a price, and I am not promising you a date. Silver is volatile, genuinely, brutally volatile, more so than gold, and it can and will have drops that test your stomach along the way. This is a case built on history, structure, and institutional behavior. It is a case, not a guarantee, and it is not personal financial advice for your specific situation. What I can tell you is how thoughtful people approach it. You own the real metal, not a paper claim on metal that someone else can dilute or default on. You size your position so that a sharp shakeout, the kind the exchanges can engineer at will, can never force you to sell at the bottom. And you do not hand your metal back to the very desks that profit from your fear the moment they turn up the pressure. Position so a drop is a discount you can take advantage of, not a margin call that ruins you. Which brings us all the way back to where we started, to that machinist in the line around the block, and to the number that everyone remembers but nobody has actually beaten. The reason this setup rhymes with 1980 is not because the price is at some magic level. It is because the same forces, a shrinking dollar, a real shortage, and a crowd that has not yet woken up, are lining up the same way they did before that first great run, except this time with a genuine structural deficit underneath it that the speculative frenzy of the past never had. And remember, even if silver did climb back to its old nominal ceiling tomorrow, in real inflation-adjusted terms, it would still be sitting well below the true peak it hit all those years ago. The summit has never been reclaimed. The setup is here. The crowd is not. That is the whole story the $50 Mirage was designed to hide from you. If you have watched with me all the way to here, then you are exactly the kind of person this last part is for, and I want to give you something real for your time. Beyond the free guide, we hold a free one-on-one educational web conference specifically for viewers with $100,000 or more in their retirement savings who watch to the end and mention that they did. It is not a sales pitch, and there is no obligation. It is a calm, private conversation about whether moving a portion of what you have built into physical gold and silver inside your existing account actually makes sense for your situation. And here is the honest reason to do it now rather than later. The best time to make a decision like this is precisely when nothing feels urgent, when you can think clearly, before the crowd arrives and the choice gets expensive and emotional. That window is open right now. If you are watching on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take the quiet moment while you still have it, because nobody, I promise you, is going to call to tell you it is time.